What if I told you a seemingly quiet, totally routine decision by the Federal Reserve is about to directly hit your credit cards, your mortgage, your car loan, and, yep, even your savings account? Sounds massive, right? Well, that decision is happening right now. And today, we're going to unpack exactly what it means for your money. You see, the Fed is widely expected to hold interest rates steady. And honestly, for a lot of folks, that sounds like a total non-event, just no news, right? But that's exactly where we need to pay attention. This expectation to just hold things steady is actually a massive deal. It's a quiet decision, sure, but it has a huge, very loud impact on your everyday finances. So let's break down what's happening, why it matters, and how it affects your wallet. Here is our roadmap for today. 1. The Fed's big decision. 2. Why rates are staying high. 3. Your debt and borrowing. 4. The silver lining for savers. And 5. Smart moves for your money. So, Section 1. The Fed's big decision. The Federal Reserve is wrapping up its latest policy meeting on April 28th and 29th. And look, all indicators point to one outcome: no rate cuts. The benchmark interest rate is going to stay exactly where it is. But here's where things get super interesting behind closed doors. We could literally be witnessing Jerome Powell's final meeting as Fed chair. See, the Department of Justice recently dropped an investigation into Powell, which essentially clears the path for a potential transition to a brand new chair. So not only are we looking at steady interest rates right now, but we might also be looking at a changing of the guard at one of the most powerful financial institutions in the entire world. That kind of leadership shift, that could change future rate strategies entirely. Moving right along to Section 2, why rates are staying high. So why isn't the Fed cutting rates? Well, let's look at the macro reasons. There's essentially a rule of three holding them back. First up, inflation is still a very real concern. Prices just haven't fully stabilized yet, and cutting rates too early, well, that could throw fuel right back on the fire. Second, you've got global uncertainty and geopolitics keeping global markets incredibly tense. And third, we're looking at a pretty shaky labor market. Companies are starting to slow down their hiring, and that's paired with consumer confidence hitting extremely low levels. Put all that together, and the Fed is basically signaling, hey, we're just not ready to make borrowing cheaper yet. And speaking of those global tensions, check out this dramatic metric: 50%. Geopolitical unrest, specifically the ongoing conflict involving Iran, has caused global oil prices to surge by more than 50%. That isn't just a random number on the screen. That directly drives up gas prices and transportation costs across the entire supply chain. It is a massive roadblock, making the Fed super hesitant to touch those rates. All right, Section 3, your debt and borrowing. Here is the tangible problem. These steady high rates make holding on to debt incredibly expensive for you. Even though the Fed rate doesn't directly set what you pay, it heavily influences almost every financial product you use. Take credit cards. Variable rates are staying high. If the Fed doesn't cut, your interest payments aren't going down either. What about mortgages? Well, they don't directly follow the Fed, but they are highly volatile right now, reacting to broader economic trends and inflation. And auto loans? Oh man, because rates are still so high, buyers are stretching out their loan terms, sometimes to 72 or even 84 months, just to keep the monthly payment manageable. But you know what that means, right? You're paying significantly more interest over the life of that car. The absolutely crucial point here is the contrast in how your debt is actually structured. On one hand, you have the pain of variable credit card interest, which simply stays expensive. But on the flip side, we have a little pocket of relief: federal student loans. Those are fixed. This means they don't change with these new Fed decisions once they're issued. So if you have federal student loans, you are somewhat protected from this holding pattern, at least for now. Let's look at Section 4, the silver lining for savers. Because it's not all doom and gloom, there is a rare win here, especially if you're someone holding on to cash. Higher rates at the Fed mean better returns on your savings accounts at the bank. In fact, right now, savers are earning yields that are actually outpacing inflation. Think about that. Your money is genuinely growing in purchasing power while it just sits there. This is a rare win in today's complex economy, and a huge benefit if you're utilizing high-yield savings accounts. Now let's pull back and look at the bigger picture for a second. There is a ton of political pressure right now to cut rates aggressively. Different sides want cuts to spur economic growth or ensure global competitiveness. But remember, the Fed doesn't take sides. They rely strictly on their core mission: control inflation and support employment. Balancing those two primary goals, keeping prices stable while making sure people have jobs, is exactly what makes holding steady at this exact moment so absolutely critical. It's a very delicate tightrope walk.
And finally, Section 5, Smart Moves for Your Money.
So, what can you actually do with this information today to protect your finances? To shield your money from these expensive borrowing costs, here are your absolute smartest moves. First, if you have high interest debts, especially those variable credit cards we just talked about, focus on paying it down as fast as humanly possible. Second, be extremely cautious about taking on any new loans right now while rates are peaked. Third, take full advantage of those high savings rates while they last. Seriously, put your cash to work. And fourth, just stay informed. The economy is dynamic and rate decisions can shift in the blink of an eye.
Which brings us to the end of today's explainer. I really want to leave you with this final thought. Is your wallet ready for the Fed's next move? As we've seen, the Fed holding rates steady might sound like a total non-event, but it touches nearly every single part of your financial life, from credit cards to mortgages to savings. Take the steps to prepare your finances right now. Thanks so much for joining me to break this all down. Keep making those smart money moves, and I'll catch you in our next explainer.